Hi, I'm Keith McCullough, and I just had a real conversation with Mr. Bradley Belt on a really interesting, albeit complex topic that you may all care about, which is retirement. We talked a lot about Social Security, unfunded pension liabilities, all that fun stuff. But Mr. Belt is currently the vice chairman of Orchard Global Capital Group. He also served under George W. Bush in the Bush administration as the CEO of the PBGC, which is, of course, the Pension Benefit Guaranty Corporation. They oversaw about $60 billion in terms of a portfolio. He served on the Social Security Advisory Board, et cetera, et cetera. A lot to talk to Mr. Belt about, a lot of topics in transition with Trump in particular. I hope you enjoy it. Maybe we'll start top down, and then maybe we can get into some smaller case studies. But top down, when you're told that the truth is 80% of pensions are funded, like how truthful is that statement?
You really have no idea at face value what that means. You would have to know all the assumptions, and there are a number of assumptions that underpin that. I would argue my own view is that when a corporate sponsor announces that they are 80% funded, that's closer to being somewhere around the real economic cost of that future obligation than would be the case in a public sector plan setting, at least for a U.S. public sector plan, whether it's a state pension plan or a county or municipal pension plan. Because heretofore, and the rules are changing a little bit in this regard, pension plans in the public sector in the U.S. somewhat uniquely have valued that future obligation. They've discounted that future cash flow stream they're obligated for at their assumed rate of return.
This is where the storytelling comes in.
That's exactly right. And unfortunately, both sides, they're both proponents of the defined benefit system as we know it today. There are critics of the defined benefit system as we know today. Unfortunately, both sides tend to use, lies, damn lies, and statistics, to their benefit to make a policy case. And that's unfortunate. It's difficult. It is unfortunately difficult to have a reasonable conversation about these issues. I can remember I spent about 18 months sitting on the Blue Ribbon panel on public sector pension plan funding, about 18 different people, coming from different aspects of the provision, different background and perspectives. And I thought very thoughtful, and for the most part, we could have a very good internal conversation off the record. But the minute we would come out with anything publicly, the slings and arrows would be coming from every direction.
Well, I mean, you really can't start with a rate of return that is off that or on that third rail. I mean, effectively, 8%, is that kind of the level that people like?
Well, that's historically been the case. It's finally been coming down. Now, it's as a result of the Pension Protection Act that was passed back in 2006. The number has gotten, I would say, more realistic. It's essentially a high quality corporate bond rate that's used for the corporate sector, private pension plans. U.S. public sector pension plans are not subject to those same types of requirements, so they've still largely used their assumed rate of return. That has started to trend downwards in most jurisdictions. The question is whether it is still too high, and in many cases, much too high.
Well, isn't that interesting? I mean, now you're at Orchard Global Capital Management, and you have, like any asset manager, or any of our clients for that matter, I mean, people have their assumed long-term growth rates. They have their assumed long-term rate of returns. They're so much lower. And I think, like, you share that view. Can you talk about that going from one place to another? Now that you're, in the private sector running that money, how you think about that?
Well, that's kind of where at the intersection of the public and private sector perspectives you get concerned, because no question, my view as an investor is we're looking for a number of reasons at likely a lower return environment over the medium to long term. And that's for structural reasons, trend line with regard to productivity growth, much slower labor force growth, much slower population growth. In fact, in the United States this last year, population grew by 0.7%, which I think was the lowest since the 1930s. And you've seen the trend line in productivity growth. We have a very low labor force participation rate right now from a historical standpoint. And actually the news is pretty good in the United States relative to other advanced economies. So if you're not getting labor force growth and actually shrinking in some economies, whether it's Japan, potentially China, Italy, and places like that, and you're not getting this spike in productivity growth like you saw in the 1990s. And the question is, where is economic growth going to come from?
Oh, it's going to come from Trump. That's the actually on the road in California, and I kid you not, one major investor said it's because Trump is the internet.
He didn't just invent it; he is the internet. Okay.
But I this is a very well educated investor going back across cycles, and he was talking about the 1990s, in particular what happened in the late 90s from a productivity growth perspective. And he was jokingly saying, "Well, we don't need the internet this time; we just have Trump." And that's a big question that people have to struggle with here, or maybe not. Some people have faded it. From a market expectations perspective, but in very short order, 2 to 3 months, we've had a change. You could argue the change in inflation expectations was already happening, but a fairly significant change in growth expectations. How short term do you think somebody, it could be a raccoon that's president for all I care. I mean, can anybody change the long-term demographics, the long-term realities that you're concerned about?
Well, that's you hit on the key issue. Demographics, no, they're with us for a generation.
It's time and space.
They're essentially immutable. Yes, all of a sudden we could start having more babies, but that wouldn't manifest itself in the labor force for another 20 years plus. We could open the doors to more immigration.
Yeah.
But we don't seem to be going in that direction.
That seems unlikely.
Yes, that seems unlikely right now. It just, I don't know why. Something I read about in the paper, I think, suggested it might be going in the other direction. Productivity, maybe, new animal spirits are unleashed. Yeah. There will be massive new investment in plant and equipment, in human capital, in education, in infrastructure, and that could have some near-term growth benefits. You're butting up against some realities in that regard. Not the least of which, the president has said, I want to have $1 trillion in new infrastructure investment. The question is, how do you pay for that? If you do pay for that, since he also wants to have fairly sweeping tax cuts. And the challenge is, okay, do we simply increase the deficit substantially, which on current trend lines I think is projected to increase the number $7 trillion on current baseline over the next decade, let alone what the president may do. You've got to deal with Congress at the end of the day, because the president can issue executive orders to a fare thee well, but to spend money, he has to get Congress to go along with that. There continue to be a lot of deficit hawks on Capitol Hill, many of whom are loath to even increase the debt ceiling, let alone pass tax cuts or new spending initiatives unless they are paid for. And so I think, where the rubber hits the road, we haven't seen that play out yet.
You also have the midterm elections running in the face of that. I mean, you have to, maybe not likely raise the debt ceiling, but you may have to raise the debt ceiling, and you most definitely have to have some kind of a spending plan. Does that play into this in terms of the timing? If he can't get it done quick, which is through executive order, doesn't time hurt a little bit?
Well, yeah. We'll have to see. When the Republicans just had their caucus meetings in Philadelphia last week, and you had the Speaker, Paul Ryan, and Majority Leader Mitch McConnell saying that they were essentially on the same page with the President and the administration on some of these big picture initiatives. Repeal and replace Obamacare. broadly speaking on immigration, on the need for tax reform, including tax cuts and lowering marginal rates, as well as on regulatory reform. But the devil is in the details. And at the end of the day, ultimately you need people to implement policy. And we've seen that this administration and this Congress are very slow off the mark to actually put in place the people that will implement the policy. We only have a handful of confirmed cabinet members right now. A number apparently haven't been fully vetted yet. A number of confirmations remain to be held. But beyond the high-level cabinet-level officials, the administration is responsible now. This administration may come back on that number, 4,000 administration appointment positions in the federal government, 1,000 plus of which are confirmable positions by the Senate. We're nowhere near, the sub-cabinet confirmable positions as well as regulatory agencies and things like that. So there's a lot of work that has to be done before you can get too far down the path on both the legislating and then implementing the legislation through regulation.
And it's interesting, the further out in time, particularly on the topics that you're so well versed in. I mean, you think of underfunded pension liabilities, Social Security. I mean, time's not your friend if you're not staffed and prepared. Like if you take Social Security, for example, I mean, you sat on the Social Security Advisory Board.
That's correct.
How would you look at that situation under any administration right now? Like the time is ticking.
Well, it has been ticking, and the clock continues to tick, and it gets like the nuclear clock, the atomic clock, closer to midnight. The long-term deficit in Social Security, I think, is now projected, this trustees report, about $11 trillion.
$11 trillion?
$11 trillion, and the Social Security Trust Fund. Now, whether there's any real trust in that trust fund, whether there's any funds in the fund is a separate conversation, but it is projected to essentially run dry in less than a couple of decades. And the question then is, what happens then? You're still collecting payroll taxes. The problem is the payroll taxes under current law would only support about 75% of current benefit levels. And so do people simply get a major cutback in Social Security benefits at that time? Or do we think about putting in place measures now to preclude that from happening? Social Security, to your point, Keith, Social Security is actually pretty easy to solve from a math standpoint. There's a few levers you can adjust that actually most reasonable, rational thinking people, if you sit them down in a room, would say, yeah, that makes sense. That's a decent trade-off. That's a good quid pro quo. And you can actually solve for the fiscal or financial deficit over the long term. It's the issue of the political willingness to actually make those changes. You alluded earlier on to kind of the third rail in Social Security has been in that in part. And that runs head on into the issue related to time frame. Now, if a president were not concerned about a second term and willing to really take on this issue and use the bully pulpit to try to push through Social Security reform, perhaps they could push through a recalcitrant Congress, members of Congress who, particularly on the House side, up every 2 years from having to take what they might perceive as difficult votes on Social Security. The classic one is, further raising the retirement age, phasing that in over a long period of time, and perhaps indexing that for gains in longevity. Seems like a no-brainer in some respects. Yes, it does have some negative implications for, those who work in, coal mines or, harder labor industries, and it has implications of the disability program. But the bottom line, it would seem to make sense. We did it before. Why not do that again? I was the director of something called the National Commission on Retirement Policy back in the mid-1990s. It was known as the Breaux-Gregg Commission. Senators John Breaux and Judd Gregg were two of the 6 co-chairs. It was kind of a disservice to the other 4 co-chairs. The 2 were House members, but that's kind of how it was known. that commission put out a very well-regarded, bipartisan, 24-member commission, unanimously agreed to set of recommendations, one of which was increasing and phasing in the retirement age over a long period of time and indexing it for inflation. When the commission's report was released back in 1998, front page above the fold in the New York Times, it was introduced as bipartisan legislation. Who came out guns blasting against that recommendation was the AARP.
Yeah, of course.
Saying, we do not accept any changes to the Social Security program, any benefit cuts, and they perceive that as a benefit cut. In some respects, it is, relative to the status quo. The question is, if you simply stick your head in the sand, the problem isn't going to go away. Mm-hmm. And that characterizes a lot of these challenges we're facing, and particularly with regard to broader issues related to retirement security, but some of these budget tax policy issues as well.
I mean, Trump hasn't touched this, has he? Or did I miss it? I mean, he's been pretty busy, so I don't know.
Well, no, he hasn't. In fact, to the contrary, during the campaign, he said he wasn't going to touch Medicare or Social Security.
Right. I won't touch the military. I will not touch, he puts a job freeze, but it's not the military, and he's got cuts, but it's not Social Security, it's not
Medicare.
Okay.
So, those have huge long-term deficits. We already are projected to have, 75 to 85% of federal revenues going to mandatory programs. Yep. Which include things like Social Security and Medicare.
Non-discretionary.
Non-discretionary, interest on the debt. And,
defense?
Defense is mostly discretionary.
But to him, it's
That's
not.
right. That's exactly right.
Yeah.
And so that's the issue. The numbers don't add up. The problem is we are, the issue we're facing. I don't want to characterize it as a problem. The issue we're facing is, historically, tax revenues have been about 18 to 19% of GDP. Expenditures have been creeping up to be 21, 22, 23, 20% of GDP, and those trend lines continue to diverge. There was an opportunity, a historic opportunity, to have a grand bargain to try to deal with that issue between President Obama and then Speaker John Boehner. And unfortunately, they couldn't reach a meeting of the minds, and that deal fell apart. We might be having a different conversation today. There might not be a President Trump today if that had happened, but it didn't. And I think it was a failure of political will on both sides, unfortunately. But it means that we are where we are today. There really are no easy answers, and that's part of the challenge.
Just seeing the divide on the truth-telling, in particular when it gets down to some of these numbers that you educated us on, whether they be unfunded liabilities or Social Security, we'll be looking forward to talking to you again often, if we can, and just wanted to thank you for your time.
My pleasure, Keith. Thanks for having me.
All right, thanks.